RA class. So you're advising a foreign company, and they've got their eyes set on Canada. It's a huge opportunity, right? But before they can even think about opening their doors, they have to answer one massive question. How should they structure their business to deal with Canada's tax system? That's exactly what we're going to break down today. Getting this right from the start is absolutely crucial.
Just a quick note before we dive in, this lecture material was prepared by Dr. Samir Al-Rashani with some AI support.
So, here's our roadmap. We'll start with the absolute fundamentals, Canada's basic tax rules. Then we'll dive deep into the two main options for setting up, the subsidiary versus the branch. After that, we'll cover some critical compliance rules you can't ignore, look beyond just income tax, and finally, we'll wrap it all up with a summary of the key takeaways. Let's get started.
First up, Canada's tax ground rules. Think of this as the foundation of the entire building. You simply cannot decide on the right structure for a business without mastering these core principles first.
So why is this so important right now? Well, check this out. Canada is number one in the G7 for growth and foreign investment over the last 15 years. That means more and more businesses are moving in, which means the demand for people like you who understand these complex tax rules is higher than it's ever been.
Okay, the single most important distinction in the entire Canadian tax system boils down to this. Are you a resident or a non-resident? It's that simple. If a corporation is a Canadian resident, it's taxed on its worldwide income, everything. But if it's a non-resident, it's only taxed on income it earns from Canadian sources. This one difference shapes every single decision that follows.
This brings us to the first major strategic choice, creating a Canadian subsidiary. You can think of this as the indirect way to operate in Canada. The foreign parent company actually creates a brand new, legally separate corporation in Canada. And for tax purposes, this new company is considered a Canadian resident.
So, as a Canadian resident, that subsidiary pays both federal and provincial income tax. For example, if you set up shop in Ontario, you're looking at a combined rate of about 26.5%. But, and you have to remember this rate changes depending on the province. Quebec, Alberta, British Columbia, they all have different rates. Your physical location really matters.
What happens if the new venture isn't profitable right out of the gate? Well, the rules for using losses are pretty generous when it comes to time. You can carry them back 3 years or forward for a full 20 years. But here's a massive point, especially for anyone used to the American system. Canada does not have consolidated tax reporting. That means losses from your new Canadian subsidiary are effectively trapped or ring-fenced within that single company. You can't use them to offset profits in another related Canadian company.
Now, for a very important concept called the thin capitalization rules. The name sounds a little intimidating, but the idea behind it is pretty straightforward. It's an anti-avoidance rule. It's designed to stop a foreign parent from stuffing its Canadian subsidiary with a ton of debt, paying itself huge amounts of interest, and essentially stripping all the profits out of Canada to avoid paying Canadian tax.
So how does it work in practice? For a subsidiary, it's a clear mechanical test based on a debt-to-equity ratio. First, you calculate the subsidiary's equity. Then, you multiply that number by 1.5. That's it. That's your debt limit from related non-residents like the parent company. If the debt goes over that limit, the interest paid on the excess amount is simply not deductible.
Okay, so the subsidiary makes a profit. Great. How does it get that money back home to the parent? Usually through dividends. And those dividends get hit with a non-resident withholding tax. The default rate is a pretty steep 25%. However, this is where Canada's network of tax treaties completely changes the game. The Canada's-US treaty, for example, can knock that dividend rate all the way down to 5% and can often eliminate the tax on interest payments entirely. This makes treaty planning absolutely essential.
All right, let's move to our second major option. Instead of creating a whole new company, a foreign corporation can choose to operate directly in Canada through what we call a branch. Don't think of a branch as a separate entity. Think of it as just an extension of the foreign parent company itself, just operating on Canadian soil.
So, when does a branch actually become subject to tax in Canada? The key concept here is called permanent establishment, or PE. A PE is basically the trigger. If a company's activities create a PE, like a fixed office, a factory, or even a construction site that's there for more than a year, then the profits earned by that PE are taxable in Canada. No PE, generally no Canadian tax on those business profits under most treaties.
Now, you might be thinking, wait a minute,
A branch doesn't pay dividends, so can it send profits home tax-free? Well, no. To level the playing field, Canada has something called a branch profits tax. This is an extra tax on the after-tax profits of the branch that are not reinvested back into the Canadian business. It's specifically designed to be the equivalent of the dividend withholding tax that a subsidiary would have to pay.
And once again, we see the incredible power of tax treaties. The standard statutory branch tax rate is 25%. But for a U.S. corporation, the treaty just slashes that rate all the way down to 5%. And on top of that massive reduction, the first 500,000 Canadian dollars of branch earnings are completely exempt from this tax. It's a huge benefit.
The thin capitalization rules also apply to branches, but, and this is a key distinction you need to remember, the test is different. Instead of a debt-to-equity ratio like we saw for subsidiaries, the branch rule is based on a debt-to-asset ratio. Here, interest deductions are limited if the loans from the parent exceed 60% of the cost of the assets being used in the Canadian branch. Same goal, preventing profit stripping, but a completely different mechanism.
Now, let's talk about some rules that apply no matter which path you choose. These compliance obligations are universal whenever a Canadian operation is dealing with its foreign parent company.
This brings us to transfer pricing. The core rule here is actually quite simple. Anytime a Canadian entity does business with its foreign parent, the price has to be arm's length. What does that mean? It means the price must be what two totally unrelated companies would have agreed to. You can't just make up artificial prices to shift profits out of Canada. Everything has to reflect fair market value, and you need to have the documentation to prove it.
So far, we've been focused almost entirely on income tax, but any business operating in Canada is going to face a much wider tax landscape. We need to take a quick look at these other major tax categories.
The sales tax system in Canada is, well, it's complex. You have the federal 5% goods and services tax, or GST. That's the baseline. But then the provinces layer their own systems on top. Ontario combines it all into a single harmonized sales tax, or HST. British Columbia has a separate retail sales tax, and Quebec has its own unique Quebec sales tax. It's a real patchwork that you have to navigate province by province.
And the list doesn't stop there. Businesses also have to plan for customs duties on anything they import, provincial land transfer taxes if they buy real estate, and ongoing annual property and business taxes that are levied by the local cities and municipalities. It is a multi-layered system for sure.
Okay, we have covered a lot of ground, so let's pull everything together and summarize the key differences when you're deciding between a subsidiary and a branch.
This table right here is your cheat sheet. Let's walk through it. A subsidiary is a separate legal Canadian entity. A branch is just an extension of the foreign parent. To get profits home, a sub pays withholding tax on dividends, a branch pays the branch profits tax. The thin cap rule for a sub is based on 1.5 times equity. For a branch, it's 60% of asset cost. And maybe the biggest one, losses in a subsidiary are stuck in Canada. With a branch, those losses can potentially be used by the foreign parent to offset its own income back home, depending on that country's rules. These are the critical trade-offs you have to analyze.
And that brings us to a final thought exercise. Imagine a U.S. parent company is setting up in Canada to do both R&D and sales. The plan is to take every dollar of profit from sales and reinvest it immediately into more R&D in Canada. So based on what we've just discussed about branch profits tax and dividend withholding tax, which structure, a subsidiary or a branch, might give them more flexibility to reinvest those earnings without an immediate tax cost? It's a fantastic question that really shows how these rules play out in a real-world business decision.